So, you want to start a business? There are different ways to set up the business, and what I'll do in the next few minutes is take you through the different business structures that you can have. There are a number of business entities or business vehicles that you can use. I'll run through the three main types of business entities. There are others, but these are the main ones. The first one is a sole trader. The second one, a partnership. And the third one, a limited company. Now, each of these business entities has its own advantages and disadvantages, which I'll run through in the next few slides. As a sole trader, you're fully responsible for the business and all the business risks. If the business fails, you can be personally liable for all the business debts and could be made personally bankrupt. As a partnership, you and your partners are responsible for the business and all the business risks jointly and severally. And the last one we'll look at is a limited company. A limited company is considered to be a separate legal entity. So what this can do is stop you from being personally liable for the business debts and can protect you from being made personally bankrupt or having your assets seized by creditors. So let's start with sole trader. There's no distinction between a sole trader and their business. So all of the business's profits are deemed to be the business owner's personal income. The sole trader is fully responsible for the whole business, including its losses, its bills and invoices, taxes, compliance, all legal considerations and finances. One of the advantages of being a sole trader is that you are your own boss and therefore you work for yourself. So you can choose your own clients and set your own working hours. There are a few disadvantages of being a sole trader. The main one is that if you run your business as a sole trader, you have an unlimited liability for your business finance. This means if your business fails and goes bankrupt, you, as the business owner, are considered bankrupt too. Unlimited liability means that all personal possessions, like your house, car or jewellery, can be claimed against by creditors and people the business owes money to. This is because all business debts are considered to be personal debts of the sole trader. As a sole trader, it's difficult to take time off work because if you don't work, then you don't get paid, especially if you work by yourself. Now let's look at partnerships. A partnership can be considered as two sole traders working together. They're both personally responsible for profit, losses, legal issues within the partnership. A partnership is formed between two or more persons. The partners invest their money or expertise in the business, and each partner benefits from any profits and sustains part of any losses, as well as sharing the costs of expenses, such as stock or equipment. There are a few advantages and disadvantages of being in a partnership. Let's look at the advantages first. The financial and business risks are shared between partners in the business. Partners may have different skill sets that can grow the business more rapidly. And each partner can have distinct roles and responsibilities, easing the burden on any individual. One of the biggest disadvantages of being in a partnership is that each partner is jointly and severally liable for the business debts. This means that if one partner runs up debts, the other partners could be held liable for those debts. Each partner has an unlimited liability for the business finance in much the same way as a sole trader, which means that if the partnership or the partners go bankrupt, then the bankruptcy could fall on all partners. I mean, in recent years, there's also been a new type of partnership called limited liability partnerships. These limit the amount of liability each partner has in accordance with the agreement and the way the LLP is set up. The last one we'll look at is a limited company. It's also known as a limited liability company. A limited liability company is considered to be a separate legal entity to the shareholders, who are the owners of the business. And what this means is that the amount of liability is limited to the assets of the limited company. One of the advantages of being a limited company is that you have an increased protection of your personal finances against lawsuits and bankruptcy. In other words, you have a limited liability. In case of business failure, your personal assets are protected, and creditors can only go after the assets of the company. Another advantage is the company can sell shares to bring in extra capital, and this can fund growth of the business. Now, there are some disadvantages as well of being a limited company. So we'll run through some of them now. Firstly, there are extra fees payable on setting up and running a company. In addition, there's greater regulation and compliance required. The financial information of a limited company is normally visible to the public. And when you're taking money out of the company, it must be paid as a dividend, salary, a loan, or a repayment of capital. The bank accounts of the limited company are totally distinct from the bank accounts of the individuals who run the company. Sometimes it's easier to look at the figures around what you could lose as a sole trader, a partnership, or as a limited company if things go wrong. So if you look at this case study, we've got individual A. They own a house worth $400,000. They have a car worth $25,000. And they've got other assets worth $25,000. They set up a business as a sole trader with £100 capital. The business succeeds for a few years and then runs into difficulty with about £800,000 of debt. Just remember these are arbitrary figures just to illustrate a point. And because they owe the creditors so much money, the creditors sue the business to recover their debt. So what the creditors will do is they'll seize the house, the car and other assets, which total $450,000. The remaining amount of debt of $350,000 will still be a debt against the individual, and they will probably be declared bankrupt. Secondly, let's look at a simple partnership. Individual A is exactly the same, a house worth $400,000, car worth $25,000, and other assets worth $25,000. Individual B owns an apartment worth $100,000, a car worth $5,000, and other assets worth 5,000. They both set up a business together as a partnership, and they put in £50 each, so they raise £100 capital, and that's what they start the business with. The business succeeds for a few years and then runs into difficulty, and again £800,000 worth of debt. As a result of poor business decisions made by individual B. Now again, because the debt is so large, the creditors sue the business to recover their debt. And what will probably happen is the creditors will seize the house, the car and other assets from individual A, totaling 450,000. The creditors will seize the house, the car and other assets from individual B, totaling 110,000. So the total assets seized is 560,000. The remaining amount of debt of 240,000 will probably be a 50% debt against individual A and a 50% debt against individual B, and they'll both be declared bankrupt. Now it's important to note that both individual A and individual B are not only liable for the 50% of the debt, i.e. 400,000 each. In this instance, individual A will need to repay 570,000 and individual B will need to repay 230,000. And this is regardless of who made the mistake and why the business went under. You might want to look through these figures again before you enter into. Now the last case study we'll look at is a limited company. We'll run through exactly the same. Individual A, it's got a house worth 400,000, a car worth 25,000 and other assets worth 25,000. They set up a business as a limited company with £100 capital. And the way the limited company would work is you pay £100 to the limited company in exchange for 100% of the shares. Now again, the business succeeds for a few years and then runs into difficulty with £800,000 worth of debt. Again, the creditors sue the business to recover the debt. As the business is run through a limited company, the creditors can only seize the assets of the company. And assuming there's no other assets in the company apart from the £100 that was paid initially to set up the company, they can only seize £100. The personal assets of the individual A are protected, and the remaining debt of 799,900 will be a debt against the limited company. In this event, the limited company will be declared insolvent and closed. However, the creditors can't come after the shareholders of the business. And there is a little proviso on this, providing there is no negligence and no fraud. In conclusion, of the three business entities we can use to set up a business, sole trader, partnership or limited company, the limited company offers the most protection to the individual if the business fails, as your personal assets are protected. However, there are a number of other ways to mitigate the risks of business failure, regardless of which route you take. In fact, there are many common reasons why businesses fail, and having protocols to reduce these business risks is essential for your business to thrive and grow. So, if you're thinking of setting up a business, already are running a business, you can take advantage of a free Zoom session of 30 minutes with one of our team to discuss your business. In this meeting, you can discuss any aspect of your business and we'll help you as best we can. So get your questions ready. To book a session, send an email to info@riskfreebusiness.co.uk. That's info@riskfreebusiness.co.uk. If you already run a business or a company, you might want to take our free questionnaire. It should take you around 5 to 10 minutes to complete. After completing the questionnaire, you'll receive a customised report highlighting the areas of risk for your business. You can find the questionnaire at www.riskfreebusiness.co.uk. That's www.riskfreebusiness.co.uk. Wishing you all success.